Good afternoon. Very nice to be here. A lovely audience, and this value investing conference is reaching new heights, and I wanted to take a moment to recognize George Athanasakos for doing such a wonderful job. George. As you know, it's not easy to organize something as effective as this. It really is a pleasure to introduce Frank Martin to you today. I haven't known Frank for long, but I've known about what he has done. And I read two of his books. The most recent one is A Decade of Delusions, which he's written. And the other one is Speculative Contagion. I'd highly recommend both these books to you. But the key about Frank is that he's long-term, value-oriented, and he's protected his clients from the major bear markets that we've all witnessed, which is 1987, the dot-com crash, and 2008. When I say protected, that means he's either gone down very little or gone up during those time periods. He's protected his client monies at all times. He's very passionate about that. Recently, of course, he's lagged the indices, but like in the past, he is protecting his clients' money again, and I have no question he will be vindicated. By the way, his 2014 annual report is a must-read for all of you value investors. It's available outside. He's got copies of it, and I think it's terrific if you have an opportunity to go through it. In his book, Decade of Delusions, if you want to know the type of man Frank Martin is, let me read to you the inscription that he has here, right in the front. It says, "May the few who profit from this book be mindful of the many who cannot." Ladies and gentlemen, let's give Frank Martin a warm, warm welcome. Frank.
I'm probably the only person in this room who has, certainly the male in this room, that's gone up runways like I've gone up today, and that's the highlight of my day. So I also want to say so much thanks to Prem and to my fellow speakers. I thoroughly enjoyed all of you guys and look forward to getting to know you more later. For the few of you I've met here today, I'd say all the better. Hopefully you'll stay with me for the next 45 minutes and we may actually cover some ground. I sort of see myself as the cleanup hitter. I can't say I'll bring it all together, but I think it was fun to listen to the diverse views this morning in hopes that maybe they'll coalesce to some extent in your minds as we proceed. We are technologically the most elite of this group of presenters today. I don't have a lot of mobility and I don't have much use of my hands, but somehow technology came along just at the right time in my life. Now, I don't happen to know much about technology stocks, but it is really here to serve us. And to that I say thanks to all the people who were so innovative in making my life so much easier. With me is Cecilia Hung, who is pound for pound the best analyst I know. You can take that however you wish. Shall we begin? According to Prem, my assignment is to talk, and your request to listen for the next 45 minutes. If you happen to finish before I'm done talking, please raise your hand and the servers will bring you another cup of coffee. In the throes of the ongoing and glorious process of enrichment, Prem's wet blanket words of caution in his 2013 letter to shareholders were as conspicuous as they were intriguing. We are reminded again of the warning from the distant past from our mentor, Ben Graham, which I have quoted before. Only 1 in 100 survived the 1929-1932 debacle, if one was not bearish in 1925. We continue to be early and bearish. That prompted an essay, Why 1925, available on our website. In my research, I learned a lot more about Prem Watsa. He is that rare man who not only has carefully considered and fiercely independent convictions, but also, as we all know, the courage to stand by them. Fairfax's portfolio bears Prem's fastidious risk management imprimatur. Like few others, he is acutely aware of an elementary principle in physics. You don't need a parachute to skydive. You only need a parachute to skydive twice. Thank you. And that is really the Prem Watsa story. He will always be skydiving. Downshifting to your speaker, at our core, MCM is a value investor. At first blush, we seem to be pretty good at it. Since 2000, our equities have produced total returns after fees of 13.5% versus 4.2% for the S&P. There were no home runs and no strikeouts. Singles and doubles and an occasional triple from well-priced, solid businesses carried the day. We bought them whenever we could find them, irrespective of market cap or market condition. And most importantly, we avoided big losers by choosing Main Street companies during the internet bubble and steering clear of the financial sector prior to the financial crisis. Since the secular peak in 2000, as a wealth manager, we have focused on conserving capital and managing risk, investing on average 43% of the portfolio in public equities, with the balance defaulting into cash and short duration municipals and treasuries. The strategy has outperformed the S&P over the last 15 years at a much lower risk profile than almost any other equity investor that we know. Our top-down worries served us well from mid-2007 into 2011 as the perfect storm, about which we wrote in 2005 and 6, blew through town and left lots of collateral damage in its wake. With a conservative portfolio, we were down less than 7% in 08, and because we had both liquidity and, as so many of the speakers mentioned today, the temperament to step up to the plate, we were back and above the high water mark by the third quarter of 09. Apart from committing a fair amount of capital to the oil field suppliers, around year-end 2014, opportunities have been relatively scarce. Even though our significant cash position yields nothing, we aren't remotely intimidated by the upward march of the benchmark. As you will hopefully glean, there are few better times to compete with a passive index, to a question that was asked today. Although almost always invested in the same assets as our clients, once in a while, a 2007, 2008 Prem Watsa, Michael Burry idea appears that is simply too unorthodox and complex for our separately managed accounts. This next chart means absolutely nothing without understanding the reasoning behind the strategy. Fortunately, and sometimes unfortunately, every move I make is documented real time. If anyone is curious, see A Decade of Delusion, Chapter 10. The strategy was written into the permanent record in June 2007 and explains the thought process behind the actions taken. Largely due to asymmetric payoffs from taking the other side of the trade against the conventional wisdom that financial innovation by investment banks represented a new and enlightened era. My private foundation's performance since 2000 averaged 15%. Fast forwarding briefly to 2015, we have conceived a fund called Hummingbird Partners, in part to capitalize on similar but exceedingly rare opportunities. But first, I'd like to talk to you about what we don't include in our worry top-down, in our definition of worry top-down. Our worries are much different than the traditional macro-centric paradigm, which is commonly used. We believe having a comprehensive and cohesive macro view is humanly impossible. There are simply too many moving parts whose weights in the economic equation are in a constant state of flux. For example, we contend that the rationale behind a number of the present policies that attempt to remedy unemployment are deeply flawed and simply wrong-headed. Singling out the recent chairpersons of the Federal Reserve, Adam Smith's admonition about wrong-headedness seems frightfully apropos. Anyone who attempts to direct the employment of capital will not only bring much unwanted attention upon himself, but also will unwittingly or otherwise assume authority that should be trusted to no political entity, however mighty, and which would be nowhere so dangerous as in the hands of a man who had the folly and presumption enough to fancy himself fit to exercise it. Years later, F.A. Hayek called such presumptiveness the fatal conceit. What we do worry about. There are two top-down variables, both predictably cyclical and somewhat knowable, that I'd like to speak to you about today: behavioral economics and market valuation. While it's convention to discuss them separately, we believe they are joined at the hip. Modern portfolio theory and its elegant mathematics, which has been derided, I think perhaps appropriately today on occasion, arrived on the scene in the early 1950s. And it arrived in hopes of turning what had long been practiced as an art into a science. The efficient market hypothesis that no one can beat the market because all information is widely disseminated and all actors are rational soon followed. As time passed, the science of investment management increasingly failed to explain the strangely anomalous behavior of markets. Behavioral economics arose to fill the void. It is simply the modern application of ideas as old as mankind. Niccolo Machiavelli elegantly argued the case that in all peoples there still exist and have always existed the same desires and passions. And later, David Hume offered the closing argument that reason has forever been slave to these desires and passions. On the slide are several of my favorite books on behavioral economics. Some are recent and some date back all the way to Adam Smith. Putting the investment as a science genie back in the bottle threatens the tenured professors who teach the mathematics of finance and who greatly outnumber those who teach management in sociology and psychology departments. As recently as 2013, the Nobel Prize Selection Committee was still undecided, splitting the prize in economics between Gene Fama, one of the real pioneers in efficient markets, obviously, and Bob Shiller, a leading advocate of behavioral economics. We value investors applaud the slow progress they're making. In the irony of ironies, the markets will become more efficient and less volatile if more investors come to grips with their own irrationality. Dan Ariely, in his book, Predictably Irrational, raised a critical point that's at the heart of the issue. Is there a cyclicality to investor behavior? Is there a pattern to what Warren Buffett's admonition clearly states, and that is to be fearful when others are greedy, and greedy when others are fearful? Perhaps, I say. In a November 1999 Fortune article, Carol Loomis synthesized the 4 speeches Buffett gave that year in which he characterized the years 1964 to 1981 as lean and 1982 to 1999 as fat, the modern day equivalent of the biblical 17-year cycle of the locusts. Given that he argued that returns from common stocks by more or less 2016 would be a fraction of those earned in the prior years, he must have sensed a rhythm, if not a rhyme. The late Sir John Templeton said the same thing in a slightly different way. Knowing market history is hugely important, not because events repeat themselves exactly, but because patterns of events and the way people make up the market react can be typical and predictable. Benjamin Graham, deservedly the Dean of Wall Street, urged that investors should have an adequate idea of stock market history in terms particularly of the major fluctuations. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the market. That's an incredibly profound statement dating all the way back to the 1930s. Taking Graham's and Templeton's observations and Buffett's 17-year cycle analogy even further, we found what appear to be discernible patterns going farther back in history, specifically to 1900. It's critical to take a moment to note the methodology, which differs materially from Buffett's. First, the S&P 500 serves as a proxy for the market, partly because of its breadth and a surfeit of available data. Secondly, the CPI rose 30-fold over the 114 years, so all data was adjusted for inflation. And finally, since dividends figured mightily in determining returns, they were reinvested in calculating total return. Since all of us in this room are conditioned to be both skeptical and rational, I suspect the reactions to the table range from bemusement to something a bit more encouraging for the speaker. I'm not going to ask for a show of hands. In examining the drivers behind returns in each period, we zeroed in on 2: the change in earnings and the change in multiples investors were willing to pay for them, to which we added the return from dividends. The sum of all forces, fundamental and psychological, express themselves through these 2 variables. Ben Graham, as was stated earlier, originated the idea of averaging earnings to smooth out the effects of the business cycle in valuing businesses in the 1934 edition of Security Analysis. Buried in its simplicity, the genius of Graham was once again made manifest. 4 years before Ben Graham died in 1976, Bob Shiller was receiving his PhD at MIT. Taking a chapter out of the master's playbook, the Graham-Shiller PE emerged as the contemporary iteration. It later became simply known as the CAPE, the cyclically adjusted PE. The chart on the left is a line graph of the S&P 500 earnings as reported. The one on the right is the same data presented as a 10-year moving average. Please note that the y-axis is log scale to keep the past and the present proportional. The best fit trend line is dotted. Juxtaposing both on the same chart shows the smoothing effect of the moving average. Hoping to give you a sense of perspective, in the upper left portion of the display, the entire 114 years of S&P index history is shown on each chart, with the phase being discussed in red. To loosely tie price and earnings, on the upper right side, we've dropped down this S&P earnings chart from just a moment ago. Please follow the earnings line in blue. Earnings almost tripled in the two boom years, 1915 and 1916, just prior to President Wilson declaring war on Germany in April 1917. Consumer prices doubled between 1915 and 1920. Real reported earnings fell from over $14 in early 1919 to less than $4 at the peak of the Depression in 1921. I should say at the low point. The CPI rebounded 20% between 1920 and 1922, based on that jumbled mix of seemingly random inflation and earnings data. On what basis would one have valued any earning asset during those chaotic times? One might argue, as I am doing now, the efficacy of Ben Graham's case for averaging earnings. The red line was made obvious during the first 2 decades of the 20th century. Now, please turn to the table at the bottom. The Shiller PE is calculated by dividing the index value of the S&P 500 by the 10-year moving average of S&P reported earnings. The compounded rate of change in the Shiller PE, a negative 4.9%, is the last data point in the second box. The third box, the Shiller EPS, follows the same protocol. The beginning and ending 10-year moving average of S&P earnings is followed by the annual rate of change, in this era 2.4%. Capital depreciation, the first number in the fourth box, is merely the sum of the annual change in the Shiller PE in box number 2 and the annual change in the 10-year moving average of reported earnings in box 3. Sounds like a game show. The negative 2.6 is precisely the rate of decline in the red line in the S&P index chart in the upper left corner. To point out the importance of dividends, the dividend return in the fourth box is added to capital depreciation to arrive at the total return for the period in question. Keep in the back of your minds as we go forward that the average total real return of 6.5% for the entire 114-year period was composed of 2.1% in capital appreciation and 4.4% in dividend return. Since it's likely that most of us think of returns in nominal and not inflation-adjusted terms, by simply adding back the average GDP inflation of 2.9% to the total real return of 6.5%, we get to roughly Roger Ibbotson's results in his seminal study dating back to 1926. With that presentation protocol now established, and as I look around the room, to present the post-lunch head-bobbing blues, let's take a 30-second break. If able, please stand, take 5 deep breaths, roll around your shoulders a bit, and return to your seats. Why don't you go ahead and move it up just a little bit. That's it, folks. We have a tight timetable to keep. I hope you enjoyed the break. Continuing our tour through history, examining the effects of valuation and psychology on markets, we go forward. The U.S. Was a small country at the turn of the century. 76 million people populated this great land long before the introduction of myriad government-sponsored social and economic safety nets as we know them today. The national character was embodied in two of the most courageous, resourceful, and charismatic personalities of the time, Teddy Roosevelt and Albert Einstein. The Industrial Revolution was in full swing. What Keynes later described as spontaneous optimism and animal spirits gave rise to growth, and overall productivity boomed. Per capita GDP rose eightfold from 1900 to 2014. Given the euphoric mood at the turn of the century, no one could have imagined that there would be two panics in the first decade, a world war in the second, and a lowercase d depression at the end of 1921. It was the last untreated depression, and it is a depression of particular interest to us. Under the laissez-faire presidencies of Harding and Coolidge, no attempt was made to stop the fall in prices and wages. Wholesale prices plunged 37%, consumer prices by 11%, and farm prices by 41%. Hourly wages fell by 22%. Because of the paucity of data, it is estimated that the maximum non-farm unemployment rate peaked somewhere between 7 and 19%. Real GDP plummeted by 9% in 1921. By today's standards, such hands-off thinking was unenlightened. Or was it? If hourly wages were allowed to bring costs in line with prices, it was reasoned that a business losing money had a chance to return to profitability. And by returning to profitability, it would have reason to invest in assets and people and thereby grow. The process wasn't heartless. Those in power understood that wage rates had to be properly realigned with other costs of production. If they were not allowed to fall, such a policy would have found favor among the dwindling remnant of fully employed workers. But society's overall income would have been lower at that uneconomic level of compensation. To the capitalists of the day, federal non-intervention did not destroy confidence. It enhanced it. I ask you to reflect on the following. The Great Depression of 1921 and the Great Recession, in caps, of 2007 and 2009, each lasted 18 months. Though the Depression in 1921 was far more severe, within 5 years, real per capita GDP had risen to 16% above its 1919 pre-Depression highs. 5 years after the Great Recession, real per capita GDP had not yet recovered to 2007 levels. Something to think about. Mired in the 1921 Depression, how could people see the future as anything but the continuation of the miserable past? And yet, valuation metrics at the time were those associated with the very lowest of tides, dating back to 1881. American author F. Scott Fitzgerald, in his great book, The Great Gatsby, defined the 1920s. In it, he explored the themes of decadence, idealism, resistance to change, social upheaval and excess, creating a vivid portrait of the Jazz Age and the Roaring Twenties. Attitudes and expectations, not fundamentals, drove phenomenal returns from common stocks. Investors at the time were greatly influenced by so-called expert opinions. Warren Buffett quotes Edgar Lawrence Smith's 1924 book, Common Stocks as Long-Term Investments, with inadvertently providing the intellectual framework for the late 1920s mania. Smith brought to people's attention what is common knowledge today. The portion of earnings not paid out in dividends is reinvested by the company, theoretically increasing its intrinsic value. Decades later, Buffett pointed out both the folly and the genius in Smith's revelation. Quoting Ben Graham, "You can get in way more trouble with a good idea than with a bad idea, because you forget that a good idea has limits." Yet another highly regarded academic, Irving Fisher, threw one of the last and largest logs on the bonfire of the vanities, publicly pronouncing the stock market had reached a permanently high plateau in the summer of 1929. No doubt empowered by the opinions of experts, Peter Bernstein addressed one of the many psychological tendencies that lead to exaggeration of the sentiments among the mass of investors that amplify the incredible market movements of the past. In their calmer moments, investors recognize their inability to know what the future holds. In moments of extreme panic or enthusiasm, however, they become remarkably bold in their predictions. They act as though uncertainty has vanished and the outcome is beyond doubt. Reality is abruptly transformed into that hypothetical future where the outcome is known. These are rare occasions, but they are unforgettable. Major tops and bottoms are defined by this switch from doubt to certainty. As is apparent from the table, the explosive returns for the 8 short years were largely attributable to expanding earnings multiples. In the summer of 1929, investors fervently believed in 2 steps forward, 1 step back. If you sold, you could buy back in the next crash, but really, there was no reason to sell at all. If you held on to a good stock, everything was okay in the end. The wise man bought and he held. In reading the 2014 Berkshire Hathaway annual report, I heard echoes from the past, even though the companion message was, over the longer term, one should avoid securities whose value is tied to the dollar. As the valuation data in the table indicate, the market had become a bubble. How could all but 1 in 100 have missed it? The nexus of this talk is the investment outcomes from the beginning to the end of the grand secular cycles. And therefore, we find ourselves straddling the 1929-1930 fence. We think it more accurate to view the crash as 2 discrete but related episodes. It's a general misconception that market bubbles end like soap bubbles in a single pop. The first phase began with the Dow's peak at 381 on September 3rd, 1929, from which point daily price volatility and trading volume convulsed into spasms of fear and relief. The free fall, which began as, in quotes, the crash on October 24, also known as Black Thursday, and ended 3 weeks later on November 13, during which time the Dow plummeted 199 points, an overall decline of 48%. During the seemingly eternal, somnolent 5 months between November 14, 1929, and April 17, 1930, the panic subsided, and the Dow marched back to 294. recovering 48% of the ground lost. President Herbert Hoover and Treasury Secretary Andrew Mellon, veterans of the 1920-21 Depression, embarked on a whirlwind of intervention to, and I quote again, stop a depression before it could start. At the president's insistence, a grand bargain was struck to forestall a depression. Neither would companies cut wages, nor would unions seek increases. Stabilization, an idea that gathered steam among economic luminaries during the mid-20s, including John Maynard Keynes, not disorderly 1921-style wage and price deflation, was the order of that day and remains the order today. When intervention failed, the relentless descent of the Dow resumed in May 1930, just as the chastised Irving Fisher doubled down, declaring, "It seems manifest that thus far the difference between the present comparatively mild business recession and the severe depression of 1920-21 is like that between a thunder shower and a tornado." The second crash was a case where investors suffered death by 1,000 cuts as the Dow slipped back into the black hole of despair, shredding all hopes as it faded from 209 to 41, losing 81% of its value over the next 26 relentlessly excruciating months. Ben Graham looks back on that episode in the first edition of Security Analysis from his perspective as an educator, a financial philosopher, and investor, and not as an economist. He captures the essence of investment transforming into speculation. At the quarter-century mark of 1925, the great bull market was underway, and Graham, then 31, had enjoyed impressive success as an investor in the challenging years since 1915. During the early 1929 conversation with business associate Bernard Baruch, both agreed that the market had advanced to, and I quote, inordinate heights, that speculators had gone crazy, that respected investment bankers were indulging in inexcusable hijinks, and the whole thing would one day end in a major crash. Years later, Graham lamented, "What seems really strange now is that I could make a prediction of that kind in all seriousness, yet not have the sense to realize the dangers to which I subjected the account's capital," money he managed for clients, family, and friends, which by 1932 had shrunk to 15% of its 1929 value. Graham's prodigious intellect was not defense enough against what he later described as a bad case of hubris. Surely Graham was not alone in having at least a vague notion in the mid to late 20s that things would end badly. What was lacking was not so much conviction, but the moral courage and the temerity to distance oneself from the teeming throngs, to say no when everyone else was saying yes. Though beaten and bloodied, his account in shambles, Graham kept his wits and his sense of proportion. Instead of throwing in the towel, as so many did, his illustrious career really began at the lowest of tides and at the humblest of notes. Based on what he wrote at that time, he saw what almost no one else saw. Stocks had never been more attractively priced. The post-World War II era morphed into the Cold War, gave birth to the baby boom and later the birth control pill, and spawned greater participation by women in the workforce. Years of pent-up demand for cars and houses coincided with a newfound willingness of banks and consumers to extend and to use credit. Americans were driven to build the interstate highway system, out of which came suburbia, television, and the glorious story goes on. Public debt shrunk as wartime debts were extinguished. But while the government reduced its liabilities, the private sector went on a spending spree, with debt rising to $9,500 to $24,000 per person as consumerism took firm root. Every single data point on the last line of the table confirms that stocks were, in fact, expensive. And yet, looking backward, investors only saw more of the same good times ahead. The adage, if it's too good to be true, it probably is, fell, obviously, on deaf ears. It took the CPI 66 years to triple from 1900. This time it did it in 15. When the pricing mechanism gets out of whack, there are always secondary effects. Nominal interest rates followed prices upward, beginning at 5% and finishing at 14%. As interest rates rose, long-lived earning assets like stocks and bonds became intrinsically less valuable. Since bond coupons are fixed by 1981, the investment of choice for those who have been in the business a long time, for so many generations, finally hit an ignominious bottom. Figuratively spat upon, bonds were called certificates of confiscation. Like the 1979 Business Week Death of Equities cover story, it was darkest before the dawning. From the post-war euphoria that had become the standard by the mid-1960s, the ebbing investment years that followed were as unexpected as they were dispiriting. GDP grew by 2.2%, but the stock market was going nowhere because of the gravitational pull of the tripling of interest rates. PE ratios declined by 2/3 to less than 8 times. Profit margins collapsed, and earnings were anemic. At the end, the country was enduring the unsettling consequences of the Volcker recession. The only bit of good news was hidden in the prices of earning assets, whether in the bond market or even better in equities. The price-to-value relationship was incredibly compelling. But what investors observed in 1982 was anything but encouraging. High rates of interest and low profits. They interpreted what they saw as more of the same and valued the market accordingly. Out of that despair emerged the greatest bull market in modern history. Although one could argue that interest rates would have fallen on account of their own weight, Federal Reserve Chairman Paul Volcker's courageous acts have become well-deserved legend. Unlike his predecessors or successors, Volcker was willing to introduce short-term pain for long-term gain. The recession in 1981-82 broke the back of inflation. Like any number of remarkable leaders, at the very time he was doing his greatest work, he was vilified. Without a doubt, Paul Volcker was the last Fed chairman not to dance to the market's tune. During this high tide era, as interest rates fell, the price of earnings assets rose. Remembering the shellacking bondholders experienced during the preceding 15 years, interest rates fell a long way before fixed income investors were induced to return en masse. It slowly dawned on them that the fixed coupons bonds offered in a declining interest rate market should be sought after rather than avoided. Once burned, twice shy equity investors were reluctant to embrace stocks as well. For the first 13 years until January 1995, the index total returns rose at an annual rate of 8%. Reminding you again of Ben Graham's earlier admonition, you can get in way more trouble with a good idea than a bad idea, because good ideas have no limits. The trajectory of the market for the final 5 years was exponential, ascending at an astonishing annual rate averaging 22.4%. It should be of no surprise then that the mutual fund investor who went into hiding after the 73-74 bear market during the ebb tide years of 1966-81 ultimately came back with a vengeance. Only 5 million families owned mutual funds in 1990. The number rose tenfold by 1999. Once a bull market gets legs, and once you reach the point where everybody has made money, no matter what system he or she followed, a crowd is attracted into the game that is responding not so much to interest rates or profits, but simply to the fact that it seems to be a mistake to be out of stocks. In effect, people superimpose an I can't miss the party attitude on top of the fundamentals that drove the market. Paine-Webber Gallup poll results released in July 1999 reveal just how myopic investors' expectations can become. The survey showed that investors who had been in the market for less than 5 years expected annual returns of 23% over the next 10 years. Even those who had invested for more than 20 years were expecting 13%. It was mindless extrapolation at its worst. Warren Buffett warned investors that looking at the future through the rearview mirror would likely leave them sadly disappointed. Based on his metrics, he thought the best the market could do was 4% after inflation. Acknowledging that, and I quote, markets behave in ways sometimes for a very long stretch that are not linked to value, he was unequivocal when he stated, sooner or later, value counts. Prices do not exist in a vacuum, but are tethered to something, even by a bungee cord. As expectations peaked, so did prices. The last line in this last table should leave you scratching your heads. The 2% total return during the post-2000 ebb tide seems consistent with history. But a Shiller PE of around 27 and a dividend yield of 1.9% are much closer to valuations during the late stages of a flood tide. The high valuations that the U.S. and other markets attained at the peak in 2000, the relatively high valuations appearing again in 2007 and once more in 2014, are not justified by underlying fundamentals, unless you believe that record, real, and nominal interest rates are here to stay, and that one, they can coexist with indefinitely with unprecedented levels of per capita public and private indebtedness, and two, with sustainable and accretive growth in per capita GDP that will in turn produce high and rising corporate earnings. And three, perhaps most importantly, that investors' appetite for return will forever overshadow their indifference to risk. By now, a distinctive and cyclical pattern may have become clearer. True to form, investors at the end of each of the 7 eras projected out into the future what they were currently seeing. Nothing is less threatening to the human need for order and symmetry than simple extrapolation of known trends. The windshield is simply too opaque for their comfort. Accordingly, when anxiousness should naturally arise, it's apathy that prevails. What may be new to some of you as this journey has progressed is the source of secular investment returns. As you re-examine this last table, you will observe that during time spans as short as 8 and as long as 21 years, changes in the average multiple of average earnings investors are willing to pay for stocks tends to carry the most weight in determining investment outcomes. Psychological and sociological forces are a large component of that multiple. Secondly, dividends have been the next most significant as well as the most stable contributor to investment returns until they faded into comparative insignificance. Growth in average earnings, while of paramount importance when the span is expanded to decades, are generally least important during these shorter secular cycles. During this zero interest rate regime, the increasing need-driven, desperate search for yield has raised the tide. When cash pays nothing, the once cautious become unwitting speculators. Now is the time when the wise investor steps out of the moment and reflects on the three most important words in investing, which we all know as margin of safety, and the four most dangerous mentioned earlier. This time is different. With history as our guide, we know investor sentiment is cyclical and valuation tends to fluctuate between finite, if imprecise, limits. We await the opportunity set of tomorrow, the nature of which we do not know, except that it will leave us in disbelief, as it always has. Is it out of the range of reason that tomorrow's born-again conservative investor might demand inexplicable premiums for bearing risk, and that the price of risk assets could be on the bargain rack once again? In the meantime, as worried bottom-up investors, we find ourselves searching for unconventional ideas in the few pockets where where risk is mispriced, and even then insisting on an outsized margin of safety. Because you're attending this conference and likely tomorrow's Fairfax shareholders meeting, it's obvious you're not part of the amorphous herd. I'm preaching to the choir when I state that the shares of all companies, privately held or publicly traded, must be owned by someone all of the time. As Prem's or Warren's 2014 letter to shareholders makes clear, there are compelling reasons for them to own all of a business. For those of us passive investors who only own fractional interests in actively traded public companies, we too have a unique advantage of which few in our profession, strangely, avail themselves. If not for client, peer, or other pressures to conform, would we not be at liberty to do nothing or anything based on a worthwhile judgment of the attractiveness of the dangers of the market, as Graham advised? As value investors, we believe that the spread between price and value can sometimes get very wide because of the manic depressive nature of the amorphous herd, allegorically Ben Graham's Mr. Market. Whether a vicious cycle or a virtuous cycle, we know that the actions of investors drive prices, and the movement of prices drive investors. When valuations are cheap and moods depressed, value investors can accommodate the disillusioned sellers by satisfying their needs with our cash. Conversely, when stocks are expensive and investors in the main are in a buying mood, we can acquiesce to their desires by selling them shares we own, or, if done smartly and conservatively, even shares we don't own. In reality, though, only 1 in 100 has been willing and able to stand up to the monolithic Mr. Market. As David stood resolute before Goliath, Mr. Market's predictably irrational proclivities can become our edge. He's a terrible master, but he's a worthy servant. If we simply have a general awareness of the ebbing and flowing of the market's secular tides, one might reason that a patient, intelligent, and enterprising investor could earn returns well in excess of the market itself. As evidence that we walk this talk, the aforementioned fund, Hummingbird Partners, will cast us in a very difficult role as a modern-day David, while we are empowered to pursue strategies similar to that described at the outset. This, should they appear, nothing takes precedence over Rule 1. To win, first, you must not lose. Even though the only permanent capital we manage is our own, we keep that same mindset in managing others. Although managing permanent capital appears like nirvana to many of us, it's an illusion. It's a radically different world to be judged solely on how well you manage money. How well you market your services in that world means nothing. Of course, we are acutely aware that encountering like-minded investors who will give you the time and the space to succeed unconventionally, to manage their money like it were private capital, is like looking for a needle in the haystack. That's why there aren't many Davids. May I close on a humble and deferential note, tempered in the crucible of fire, like few others before and after. Ben Graham earned his place in the pantheon of the handful of the greatest thinkers to ever ply our trade. His exquisite understanding of men, markets, and business, expressed in the transcendent gift of the written word, have become timeless classics. His teachings are as relevant today as they will be 100 years from now. He wrote in part about his foibles and his follies, and those of men in general, that we might be spared the agony of repeating them ourselves. May his words not have been written in vain. If you choose to applaud, may it be in honor of Ben Graham and the many in this room who pay homage to him in the most tangible of ways, by their deeds. Thank you very much.